So the Southwest Florida homeowners and business owners are still feeling the devastating blow of Hurricane Ian's wreckage long after the dangerous storm made landfall. And they're beginning to find out just how hard and challenging this recovery may be, exposing Florida homeowners in the Tampa, Fort Myers area and their vulnerabilities that many just weren't financially prepared for. With a recent headline from Fox 4 News in Southwest Florida reading, "Insurance deductible may not be enough to meet Southwest Florida demand." So the article from Fox 4 said Governor Ron DeSantis awarded $5 million to 6 counties back in October, and Lee County has started accepting applications for a state-funded insurance deductible program. However, it may not be enough to meet the overwhelming demand. Trey Price, Florida Housing Finance Corporation's executive director, said there may be more demand and more need for the program than is currently allocated. The money is being split between Lee County, Charlotte County, Collier County, Hardy County, DeSoto County, and Sarasota County. And this money could be used to help impacted families rebuild. Family homes that suffered severe roof damage and intense floodwaters. Homeowners insurance adjusters have been very busy in light of the recent Category 4 storm, and policyholders have been filing claims since pretty much the week of the storm. Now, here's the kicker. Homeowners are on the hook for insurance deductibles in the neighborhood of $14,000 or more, and that doesn't even include flood coverage. Tack on another $13,000 for flood insurance deductibles on top of that. Ouch. So the $5 million fund is based on allocations that are based off of damage data from FEMA and the Florida Department of Emergency Management. And the overwhelming problem is that the need outweighs the cash available. So Fox 4 News reported that Charlotte County had to stop accepting applications 3 days after opening up the program. They said it was because demand outweighed the money they anticipated on getting from the $5 million pot, and noted that there are other resources that could possibly be available to homeowners in need through church groups, charities, and other community organizations. So the simple fact of the matter is that people who have experienced this life-changing devastation need help. One Southwest Florida homeowner said, "I could use just a little help, a little bit of extra money to cover the deductible so I can get this house back in order." So that's just it, folks. This could have happened to almost anybody. And for many Americans who don't even have enough in savings to cover a $500 emergency, what would you do if you were facing a $27,000 insurance deductible? And for some, a huge financial impact like the unexpected catastrophic damage to your home could be the tipping point that literally wipes you and your family out. And so, what can anyone do to prepare for something as bad as Hurricane Ian, or perhaps maybe even something far worse? Well, the answer to that is it really depends. It depends a lot on different factors and circumstances in your current situation. But I know that for me and my family, we will be continuing to build up our safety net, have savings and emergency savings, building up cash reserves, investing, and making sure that we are not using our credit cards, we're not maxing out our credit cards, we're not carrying balances on our credit cards, forcing us to spend money in interest fees and things like that, while also having them available for the case of a possible emergency. Now, granted, we're not in a situation where we would see a huge homeowner's insurance deductible right now because we're still waiting to make our next purchase in real estate. However, with that being said, money is always going to be the driving force and factor in survival. And in this case, for the Southwest Florida homeowners affected by Hurricane Ian's destruction, that driving factor is just rebuilding what was there so they have a place to live, a place to call home, a place to rest their head at night and get their family life back to normal. And we have increased pressure and complications with the rebuilding and repairing of these areas as a result of diesel fuel pricing and shortages, which is going to ultimately make the transportation and delivery of the goods and materials down to these areas much more difficult, while also increasing the price of the materials because of the increased freight costs. Now, with that being said, we could possibly see some insurance companies facing catastrophic damage themselves with these higher prices and added costs that just make it even harder for them to weather the storm of paying out these claims to have these homes repaired and fixed. As we know that a majority of the Florida housing market insurance providers are pretty much underwater, and they do not have the assets available, the cash available to actually pay out a large portion of claims if they were to see huge widespread damage in Florida or across the country, as these companies are underwriting policies all over the country and some of them all over the world. Now, these are troubling economic times that this is really an urgent warning for folks with these assets like real estate to be very considerate of, be mindful of. Check your policies. Make sure that your policies have the appropriate coverage. You got to think, with the increase that homes saw in appraised and appreciated value and increased equity, that may have had an effect on your insurance coverage as far as how much your homeowner's insurance is valuing your property. And the last thing you want to do is come into a situation where you may even face a total loss scenario, and the insurance company says, we'll pay your claim, but we're only going to pay it based on what what the original underwriter valued the property at 10 years ago, and you don't have the coverage for the increased equity now. Although home prices are on the decline, they're declining slower than they increase, and there's still a fair amount of value and equity out there that could be retained in the event of a total loss scenario or an insurance claim payout. You don't want to, and also you want to make sure your insurance has the proper coverages. The last thing you want to do is be like some Florida homeowners in these situations and realize that you don't have flood insurance. Even if you're not on the coast, there's a possibility of flooding, not necessarily just from a natural disaster. A water issue in the home by any means is categorized and classified as a flood situation. And if you don't have the coverage, then you're going to be left paying out of pocket. And then if you're left paying out of pocket, then that could put you in a position where you can't afford it. The home is unfit to live in, and now you're in a situation of perhaps maybe danger from the bank wanting to a due on sale clause or possibly forced foreclosure. Landlords, renters as well. Landlords need to be making sure that they have the coverages, because renters, if your landlords don't have the coverages in the property that you're renting, that you have a lease on, that you're living in now, has any sort of damage, any catastrophe, any problems that need repair, but the landlord doesn't have the proper coverage, well, guess what? Odds are they won't be getting repaired, which means that you're going to be living in an undesirable condition and possibly facing the need to relocate. If there were a massive problem with this property and the landlord didn't have the means, the insurance coverage, the funds to repair it. And these are just some of the basic things that we should all be mindful of and preparing for in the event that any SHTF moment could happen, regardless of whether it may be a food insecurity or a diesel price insecurity or a diesel shortage or additional conflicts, cyber attacks. All these possible life-changing events are things that we should all be cognizant of and paying attention to, and paying attention to the warning signs, the urgent warning signs, so that we are prepared for all of them. Not just to the point of which you say, well, my home has been damaged and I can't afford to pay my deductible, but I do have a pantry full of food. Well, if you don't have the proper insurance coverage, you're not prepared. If you don't have the money available to pay the deductibles that you've agreed to, the amounts that you've agreed to, then you're not prepared. And although you may have some food in the pantry, well, ultimately that food is going to be worthless if the house is inhabitable, and eventually that food will run out, and that food cannot be used to pay these deductibles, at least not yet. We're not to the point of which we're bartering food for trading for goods or services. But at the end of the day, these are the warning signs, folks. I don't want to bring you just bad news. I want to bring you news that is of real life events and scenarios to really kind of get your wheels turning and start thinking about what's going on and what could be and what could happen, because that's how you prepare for the what if. We don't prepare for food shortages and EMP strikes and nuclear war threats and preparing our go bags and the fact that they have happened. We're preparing for the fact that they could happen. And with that being said, what's on the horizon is the likelihood and possibility of the Fed further damaging our economy and the livelihoods of millions. And what could happen is mass layoffs. What could happen is diesel shortages. What could happen is increased inflation and unbelievably high prices, what could happen is a deep recession and depression. Which being said is we are already in a recession. And if you guys don't know, then let me just tell you, we are in a recession. The odds are that just like we have seen in the past historically, we will be informed by the Fed, by the Biden administration, or perhaps maybe the next administration, that when they actually say that we experience a recession, it will be after the recession has already begun to recover. It's all based on history. They'll look back and say, okay, based on the numbers, based on the statistics, based on the charts and the graphs and the reports, yes, we were in a recession beginning in August, July, maybe. They'll say, oh yeah, we've been in a recession. Now we see the numbers, now we see the data, now we can confirm it. As they're saying that we were in a recession, we'll already be in the recovery. But if you're not planning and preparing for what could happen, then you're ultimately not prepared and could suffer the consequences of such, which I'm telling you guys right now, the recovery period is going to be when you make hay, okay? The recovery period is going to be when you make hay, and this is going to be the game changer. This is going to be part of that great reset. And the recovery is going to set apart the winners from the losers. The recovery is going to decide who's going to be basically at the absolute bottom and who's going to have a chance to survive. There's not going to be any in between. But if you wait until the recovery begins to then try to get ready, you're going to get left out. You're going to miss out, and you're going to be at the bottom. And when the recovery begins is when they're going to say that we were in a recession. With that being said, they're not going to tell you that we are now experiencing the recovery until months, maybe years after that. And by then, it's too late, and you've missed out.